Which of the following statements regarding sector indexes is most accurate? Right. So again, the idea here is if you look at statement one, right? A, track different economic sectors and cannot be aggregated to represent equivalent of a broad market index. It is wrong, right? Because sector indices can be combined to form a broad index. So it's wrong. Provides a means to determine whether an active investment manager is more successful at stock selection or sector allocation. Again, this gives you that idea, so that's okay. It's correct because we are able to find out, did manager pick good stock or just choose the right sector. Apply the universally agreed upon sector classification system to identify the constant securities of specific economy sectors such as your consumer goods, energy, finance, healthcare. Not correct, wrong, right? Because different providers use different classification systems. So very, very important. Please understand when you use an index. Index is used for market sentiments, your benchmarking, your asset allocations, your beta, CAPM, passive investing type of index are broad market, which are whole market, multi-market, which are global, regional, sector, industry specific, style, size, value, growth. Please understand difference between systematic versus systemic, rebalancing versus reconstitution, benchmark must match your strategy, etc. Okay. Then we go ahead to the next question. Which of the following is an example of a style index, right? When you talk about your style index, index based on geography or your economic sector, or your market cap, style index is how you invest, includes your size, large cap, mid cap, small cap, value versus growth, right? So it is not your geography, it is not your economic sector, it is your market cap, right? This is your style, size based classification. You have style is equal to your size plus your value or plus growth, right? Then again, keep in mind, right? So it's not geography, it's not economic sector, it's market cap. This is style, size-based classification, right? Then we go. Which of the following statement regarding fixed income indexes is most accurate, right? Liquidity issues make it difficult for investors to easily replicate fixed income index. That's correct, right? So that is there, right? Liquidity issues make it difficult for investors to easily replicate fixed income indices. Illiquid bonds hard to replicate. Rebalancing and reconstitution are the only source of turnover in fixed income indexes, right? Wrong. Turnover also from bond maturity and new issuance. Then you have fixed income indexes representing the same target market, hold similar numbers of bonds, right? Again, it is kind of wrong, right? Huge variation across provider, right? So that is what we are looking at. Okay, so is the answer. So that's what we get. Question number 27. An aggregate fixed income index is what? Your only corporate and ABS, your only governments can be subdivided. See, aggregate index is equal to your broad universe, right? Includes your government, corporate, and securitized. So comprises corporate and asset backed, narrow. Represents the market of government issued securities, narrow. Can be subdivided by market or economic sector to create more narrowly defined indexes, correct? Okay. See, the key idea here is what we need to understand is aggregate is equal to your whole bond market. And then they are broken down into segments, right? So remember that. Then we get into question number 28. Fixed income indexes are least likely constructed on the basis of what? Maturity, type of issue, coupon frequency, right? So generally it is maturity, it is made least likely. So it is made, type of issue it is made, coupon frequency, right? Coupon frequency not used, right? Coupon frequency can be annual, semi-annual, does not define your risk return meaningfully, right? So overall, what we need to understand is a style index where size or the market cap is the main play factor. Then you need to understand value versus growth, equity index construction, market cap rated, code adjusted fixed income, classified by issuer, maturity, credit quality. Big difference from the exam perspective is that if you're looking for turnover, equity index has low turnover, bond index has high kind of maturity, at maturity, liquidity. Equity index is high, bond index is low, replication, equity index is easy, bond index is kind of difficult, right? Then we go into question number 29. In comparison to equity indices, the constant securities of fixed income indexes are more liquid, easy to price, drawn from a larger investment universe. It is drawn from a larger investment universe, right? Not, I told you, right? It's not more liquid, not easy to price, right? It's drawn from a larger investment universe, right? So remember that it's the difference between equity and fixed income, which I just told you, right? Right. Then you have commodity index values are based on your future contract prices, the market price of specific commodity, the average market price of basket of similar commodity. So we look at your C, right? Commodity index values are based on the average market price of a basket of similar commodities, right? Uh, Commodity index values are based not on their futures, not on the market value of specific commodity. This is the average market price of a basket of a similar commodities, right? So index will be based on basket, right? So sorry, not this one, right? So we are looking at not, no, sorry, I got it mistaken right here. So remember this part. See, again, the confusion came from average market price, right? Please understand when we take commodity index value, right? Those are not on your average market price, right? They're not on, they are based on your futures, right? And there is a reason for that, right? So please understand very clearly. So this is, again, I missed out here. Please understand very clearly. So stupid mistake. These are based on your futures contract price. You see, index value, I thought the index value will be based on your average market price, right? No, index values are not based on average market price. They are based on future contract price, right? Remember that future contract prices. So of your one or more commodity, right? Future contracts on one or more commodity. Common confusion. Don't fall for this trap, right? Right? Don't fall for this trap. Okay, question number 31. Which of the following statement is most accurate, right? Most accurate. Commodity index all share similar weighing method. No, right? Commodity index contains the same underlying commodities. No. Performance of commodity index can be quite different from that of the underlying commodity. Right? That is true, right? Because it's a combination, right? It's a combination, right? So the performance of commodity index can be quite different from that of underlying commodities because the index is consist of future contract on the commodity rather than the actual commodity, right? So 31 is C. Then we go to 32. Which of the following is not a real estate index category? Right? Appraisal index, yes, it's a real estate category. Initial sales index is not the category. B. Repeat sales index is not the category, right? Is a category, right? So answer is B, right? So not a real estate one is your okay, initial sales index, right? So it's not real estate index category B, right? Your initial sales index, right? Okay. Then we go to question number 33. A unique feature of hedge fund indexes is that they are frequently equal weighted, right? No, is not frequently equal weighted. Hedge fund indexes we are talking about it cannot be equal weighted. Are determined by the constituent index, perfectly fine, right? Reflect the value of the private rather than public investment, no, right? It is determined by the constituents of the index, right? So that is the answer here. Again, you have to understand these properties, right? They are very important. This is the answer. Hedge fund is not required to report their performance to any party other than their investor. Therefore, each hedge fund decides to which database it will report its performance. That's for a hedge fund index, and still determine the index rather than the index provider determine the constituents, right? So that's why judging the hedge fund performance is very difficult, right? Question number 34, the returns of hedge fund indexes are most likely biased upward, right? Because they choose their own index, right? Right, which were given in the earlier one also, right? So remember that point. Okay, so voluntary performance reporting may lead to survivorship bias and poorer performing hedge funds and will be less likely to report their performance. Okay. So that is what we have. Um, all right, guys. With that, we have finished the chapter. Again, what is important to understand here in this chapter is that there's a lot of theoretical concept here, easy concepts, right? But there's a lot of stuff here, and most importantly, you have to remember small final things. So go back and do the theory, then attempt the questions. CFA, the good thing is the questions are absolutely very important material for passing the exam, right? So do that, right? Go back to the question, 34 questions, right? You have to do. And value and market value of company security is what? Will it be negative, it's zero, or positive? It will be zero, right? It will be zero. Why it is zero? Right? It will be zero. The reason is that in efficient market, the market price should reflect the intrinsic value. So market value is equal to intrinsic value. Hence the difference zero, right? Do not overcomplicate it. This is not saying your prices are magically perfect every millisecond in real life. It's testing the basic theoretical idea. Efficient market, price reflects your value, right? So B is correct very easily, right? So this is done. Then we go into your next question, which is the intrinsic value of an undervalued asset. The intrinsic value of an undervalued asset is what? See, we are looking for intrinsic value of an undervalued asset. See, intrinsic value of undervalued asset is greater than the asset's market value, right? Why? Because an asset is undervalued when your intrinsic value is greater than market value. In other words, the asset is worth more than what the market is currently charging. So undervalued is worth more than the price. Overvalued actually worth less than the price. That's simple, right? So very easy. Undervalued is the estimated true worth. Market value is the current trading price. If intrinsic value is higher than the market value, then the asset is undervalued, right? Remember that. Very simple. Okay. This is done. That's why I told you, right? This is not so difficult chapter, right? Once you understand. Question number 3, the market value of an undervalued asset. Again, it's the flip side of that. The market value of underlying valued asset is value at which an asset can currently be bought and sold, right? This is again B, right? Very simple. Market value always means the current transaction price. It does not matter whether the asset is undervalued, overvalued, fair valued, right? Market value is equal to actual trading price. Intrinsic value is the estimated fundamental worth. Right? Option C, equal to the present value of all assets expected cash flow. That describes your intrinsic value. So that's not the answer. Greater than the asset intrinsic value, right? Not necessarily, right? Market value greater than the asset's intrinsic value. No, right? Undervalued means your intrinsic value is actually higher than the your what you say the uh, the market value, right? That's the whole idea, right? B is the answer. Okay. And then we go to the practice question number 4. Right. In an efficient market, the change in company share price is most likely the result of what? See, efficient market, the change in the price, right? The inefficient market, only new unexpected information move your prices, right? So C is correct, right? Why not A? Because not insiders, right? Because insider trading is illegal. Efficient market assume prices reflect your public information. Why not B? Because past price is already known, already reflected in current price. This is the whole idea of your new information coming into the market, right? So very important to understand. Price changes are independent of yesterday. This is the core CFA concept. Market moves based on new information and not patterns, right? This is very important. Okay. Then we go ahead to next question number 5. Regulation that restricts some investor from participating in the market will most likely be what? See, regulation which restricts some participants from participating will impede your market efficiency, right? A. Right? Why it impede your market efficiency? Because less participation, less efficiency, fewer traders, less competition, slower price discovery, right? Reducing participants, increase your market imperfection. Always remember, more participants, more efficiency, more efficient markets, right? Very straightforward, very simple. Then we go to question number 6. If short selling, with respect to efficient market theory, when a market allows short selling, the efficiency of the market most likely happens what? It increases your efficiency, right? So increases efficiency. Why it increases efficiency? Because short selling helps correct your overpricing. Without short selling, people can buy undervalued asset, but cannot easily profit from overvalued asset. Only half the market corrects. Very important core takeaway: short selling is equal to your price correction mechanism, help eliminate your bubble faster. Very important. Okay. All right. Then we go to your practice question number 7. Which regulation improve your efficiency? Does it restricting your short selling, restricting your foreign trader, restrict your insider trader? Right. The correct option is C. Right. Which of the following will most likely contribute to market efficiency? Regulatory restrictions on insider trading. Right. So insider trading creates unfair advantage, unequal information, discourages your participation. When restricted, fair playing field, more investor participate, more confidence, efficiency increases. So fairer markets, more participants, better efficiency, regulation that improve your transparency, reduce unfair advantage, increase your efficiency, right? So remember that. Very, very important for the exam perspective, right? Please understand each thing very, very well, right? So this is done. Then we go to question number 8. Question number 8, we are looking which of the following market regulations will most likely impede market efficiency, right? Impede market efficiency, restriction on traders' ability to short sell. We discussed this, right, in the previous question, right? So we are testing what reduces your efficiency. So when you are restricting short selling helps you identify overpriced asset, push prices down to fair value. If you restrict it, overvalued asset stay overvalued, price correction slows, efficiency decreases, right? If you look at option B, allowing foreign investors, again, this is wrong. Why this is wrong is because more participants, more capital analysis, competition, price becomes more accurate, efficiency increases. Option C, penalizing insider trading, this improves your fairness, stress participation, efficiency improves. So what is important to understand is that anything that reduces trading freedom or arbitrage is equal to reduce your efficiency, which is very, very important to understand. So restricting your short selling reduces your arbitrage, inefficiency increases. When you allow, efficiency increases. When you restrict, efficiency decreases, right? So remember that. Okay, so this is done. Then we go to question number 9. An increase in the time between when an order to trade a security is placed and when the order is executed most likely indicate the market efficiency has, again, when time has increased, means efficiency has decreased, right? Efficiency has decreased. Why? Because this is about your market friction, operational efficiency. Why does the delay matter? Because if execution is slow, prices may change before trader or trade executes. Traders cannot act quickly on information. Arbitrage becomes kind of harder. Inefficiencies persist, right? From the, illiquid markets, a slow execution, widespread, less efficient, high frequency trading markets, execution in milliseconds, highly efficient, faster execution, faster price adjustment, more efficiency, slow execution, delay in price discovery, less efficiency. So the core idea is operational inefficiencies leads to market inefficiencies, which we don't want, right? Okay. So once we have done this, we go to the questions. Question number 10, with respect to the efficient market hypothesis, if security prices reflect only past prices and trading volume information, then the market is what? If you are reflecting only past prices, right, then it's a weak form, right? Right, because only past market data is reflected. This is the definition of weak form. Weak form, past prices or volume, semi-strong, all public information. Strong is public as well as your private information, right? So weak form is the past market data only, right? So that is what we have done. Then we go into next one, which is question number 11. Which of the following statement best describe the semi-strong form of market efficiency? Semi-strong is your security prices reflect all publicly known and available information, right? So this is your semi-strong. I told you in the notes also, semi-strong includes past data and public information. Why A is wrong? Because this is weak form past data, right? Why C is wrong? Because forms are hierarchical. Strong is greater than semi-strong, greater than weak. So semi-strong must include your weak form also, right? That is very important. Semi-strong, all publicly available information, right? So remember that very, very clearly. You have to keep that in mind perfectly, right? With that, we go into your practice question number 12. If price reflects all public and private information, the market is best described as your strong form, right? This is what your strong form, because your public also and private also, right? So both are there. So this is strong form, which I told you, right, in the notes. Question if markets are semi-strong, efficient, standard fundamental analysis will yield abnormal trading profits that are zero, right? Equal to zero. Why zero? Because all public information already priced, no extra profit possible, semi-strong, abnormal return zero. Core idea is fundamental analysis is not equal to alpha. In efficient markets, the markets are, semi-strong, efficient, right? You don't get abnormal trading profits, right? So we have done this. Question number 13. Okay, then we go to question number 14. Question number 14, if markets are semi-strong, efficient, and passive portfolio management strategies are most likely to do what? See, they are able to earn your abnormal return, outperform your active strategies, underperform active. So correct answer is here is B, right? Why? Because active strategies incur your costs, cannot consistently beat your market. Passive low cost matches the market, so passive wins after cost. The critical insight here is this is not saying passive is better inherently. We're saying active cannot justify its cost, right? So core idea, cost kill your active strategy. Very, very important to understand, right? So markets are not perfectly efficient, but they are efficient enough that easy money is gone. Only skill, speed, and structural edge wins. Efficiency is basically information already priced in. More efficiency is equal to less opportunity to beat the market, right? That's what we need to understand, right? So once we have done question number 14 also, now we go to question number 15. When we go to question number 15, a market is semi-strong form efficient, right? Market is semi-strong form efficient. The risk-adjusted returns of a passively managed portfolio related to an actively managed portfolio are most likely what? Lower, higher, or same, right? It is your higher. Why it is higher? Because semi-strong efficiency means all public info already priced, so active managers cannot generate alpha, but they still incur your cost. So active before cost same, passive is same. After cost, active is lower, passive is higher. So risk-adjusted return of passive is greater than your active. Semi-strong passive wins after cost. That is why index funds dominate globally, right? Warren Buffett recommends your passive investing. We need to know. Okay. So this is what we have. Then we move to your question number 16. Technical analysts assume that markets are weak form efficient. The two weak form efficient, one semi-strong form efficient, right? So answer is B, A or B, whatever you want to check, right? So, okay. Weak form inefficient. Sorry, I didn't read inefficient. Weak form inefficient. Right. See, technical analysis use your past price plus volume, but weak form efficient market hypothesis says past data is already priced. So if technical analysis works, weak form must be false. Market is weak form inefficient. If you believe in technical analysis, you must believe in weak form inefficiency. Charts working means weak form kind of broken. HFT and quant funds exploit your micro inefficiency. Retail technical trading is mostly like noise, right? Which you understand, right? So if you believe charts are working, it's a weak form kind of broken means it is your market is weak form inefficient, right? Weak form inefficient, right? Technical analysis assumption, weak form inefficient. Right? So very, very important. This is given technical analysis use past prices and volume to predict your future prices, which is inconsistent with the weakest form of market efficiency. Weak form, right? Weak form market efficiency state that investor cannot earn by trading on the base of past trend, right? So meaning weak form inefficient, right? We are talking about. Then we go to your question number 17, which is about fundamental analysis. Fundamental analysis assume that the markets are what? Fundamental analysis assume that the markets are semi-strong inefficient, right? Semi-strong inefficient, which is C. Why semi-strong inefficient? Because fundamental analysis use public information, but semi-strong efficient market hypothesis says public info already priced. So if fundamental analysis work, it must be semi-strong, must be false. Market is semi-strong inefficient, right? So you are getting, if technical analysis work, it is weak form inefficient. If fundamental analysis work, it is semi-strong inefficient. When we're looking at balance sheets or earnings edge, that is semi-strong broken. Analysts don't just exploit your inefficiency, they reduce your inefficiency over time, right? Which is very, very important. Okay. Then we go to question number 18. If the market is weak form efficient, but semi-strong form inefficient, then which of the following types of portfolio management is most likely to produce abnormal returns, right? So you have weak form, efficient, semi-strong, inefficient. Which strategy gives your abnormal return? It is your fundamental, right? Fundamental. So active portfolio management based on fundamental analysis gives you return. So let's try to understand. This is a little tricky, right? See, when you have weak form, efficient, right? So past data is kind of useless. So technical analysis kind of fail. When you have semi-strong, inefficient, public info not fully priced, fundamental analysis work. So if your strategy is technical, right? Uh, again, that's a strict no, right? Fundamental work, right? Passive, no alpha, right? So weak form, efficient, no technical, semi-strong, inefficient, right? Weak form efficient means no technical, because this works in weak form inefficient. Semi-strong inefficient means your fundamental. Yes, fundamental, right? So that is why it is based on your fundamental analysis, right? Remember that. Question, which of the following is least likely to explain the January effect anomaly, right? So that is your B, release of new information in January, because January effect is seasonal. Your behavioral, not due to new information. So January effect is equal to tax plus window dressing, not your new information. So please understand that, right? So there are types of anomalies, time series, January, which is momentum driven, cross section size, which is value driven, event based, earning drift. You should have a reality check. Most anomalies fade over time, are not explainable. Big ideas, markets are not perfectly efficient, but efficient enough to kill easy money. The one line idea here is alpha exists in theory, disappears in practice, which we have. Okay, so which we understand. Then we go to question number 20, right? Question number 20, if a researcher conducts your empirical test of a trading strategy using time series of returns, finds statistically significant abnormal returns, then the researcher has most likely found, right? So the reason for that is market anomaly, right? So what is happening is that just because you found abnormal returns, right, doesn't mean market is inefficient, doesn't mean you can make money in future. It simply means pattern exists in historical data, right? And it's kind of anomaly, right? Why not B and C? Because market efficiency could be bad model, data mining, survivorship bias. Bad model means wrong expected return, future profit not possible, not reality, because in reality, transaction cost, kill your profit strategy may not persist. So backtest your success. And if you have backtest success, is equal to anomaly, not guaranteed alpha, right? So that's what we have. So we have seen this. Then if we go to question number 21, researchers have found that the value stocks have consistently outperformed growth stock, and investor wishing to exploit the value effect should purchase the stock of companies with above average what, right? So if you are looking to learn how to exploit your value investing, right? So answer is dividend yield, right? So logic here is value stock are cheap stocks, metrics P by E, your M by B are low, dividend yield is high. And why others are wrong is because if you look at market to book, value stocks have low, not high, your market to book. So, price by earnings, value stocks have low, not high. So value is equal to cheap. Cheap is equal means high dividends, low price multiples. That's what we have. Okay, so this is done. Then we go to question number 22. Which of the following market anomalies is inconsistent with the weak form market efficiency, right? So it is your momentum pattern. Why momentum pattern? Weak form efficient market hypothesis says you cannot use past prices to earn your abnormal returns. Now, when you look at your options, right, your earning surprise, right, based on new information, which is a semi-strong issue. So this is not the thing. Again, we are looking for weak form, right? Momentum, use your past returns, kind of, what you say, right, leads to your future return. This is a direct violation of weak form. We are looking for inconsistent. So this is the answer. Close-end fund pricing anomaly not based on past price trends. So weak form violation is equal to any strategy which use your price pattern, right? So answer is B. Right. Then we get into your question number 23. Right. With respect to your efficient markets, a company whose share price changes gradually after the public release of annual report most likely indicate that the market where the company trade is what? See, if there is a gradual kind of change, right? So So it means receiving additional information about the company, right? It means in efficient markets, all available information already priced. So if price still moving, something new is coming in. Why not A, semi-strong form your efficient? This is a tricky question, guys, because that's an immediate adjustment, but here adjustment is gradual, not perfect. Why not B? Because behavioral bias is possible, but question assumes efficiency framework. So gradual movement is equal to information arriving over time, right? And then we have done question number 23 also. And then we go to question number 24, right? Question number 24. With respect to rational and irrational investor decision, the efficient market hypothesis require what? Right. So efficient market hypothesis required only that the market is rational, right? That is one of the things, right? Efficient market hypothesis does not require all investors to be rational. Why? Because even if some investors are irrational, arbitrageurs, correct your prices, market becomes efficient on average. Why not be? Because all investors rational, too strong, and unrealistic, right? Then why not C? Because some investors are irrational. That also not, because that's behavioral finance, not efficient market hypothesis requirement. The key idea is efficient market hypothesis is market outcome is rational, not your individual behavior. So that's what we need to remember, right? So this is very, very important. So once we have done question number 24 also, then we go to question number 25. Observed overreaction in market can be explained by investors' degree of what? Loss aversion, right? Why loss aversion? Because overreaction means prices move too much to news up or down. Why does this happen? Because of loss aversion. Investors hate losses more often they like gains. Emotional reaction is stronger on downside. What actually happens is bad news, investor panic, sell aggressively, price crashes more than justified. Good news, over optimism, price shoots too high. This creates overreaction effect. Why not others? Because risk aversion just means dislike for risk, doesn't explain overreaction intensity. You look at your confidence in market, too vague, doesn't capture your behavioral asymmetry. Overreaction is basically your emotional asymmetry, your loss aversion. Then we have your question number, your 26. Question number 26, like traditional finance models, the behavioral theory of loss aversion assumes that investor dislike risk. However, the dislike of risk in behavioral theory is assumed to be what? Leptochaotic, your symmetrical or asymmetrical? Asymmetrical, guys. There's nothing called leptochaotic here. Traditional finance risk perception is symmetrical, gain of plus 10 and loss of minus 10 treated equally. Behavioral finance is not symmetric, right? Losses hurt more than equivalent gain fees. Good. This is the key concept. Value function, your prospect theory is the logic behind it. Steeper for losses than gains. Kink at your reference point. Same magnitude, loss feel 2x stronger than pain. Why not others? Because leptochaotic about fat pills in your distribution, not about your behavior. Symmetrical, that's traditional finance assumption. Investor behaves like if I lose $100, pain is huge. If I gain $100, happiness is limited. That imbalance is your asymmetry. Concept of loss aversion, basically outcome is overreaction. Asymmetry in risk is behavioral anomalies. Emotional bias is equal to market inefficiency short term, right? So we need to understand that, right? So with this, we have completed the chapter. This was, I think, the last question, right? With this, we have completed the chapter, guys. Go back, revise it, solve the question, right? We have done it. You have to go back and do it. There are 26 questions, practice it, but it's not a very difficult chapter, right? A few points which you have to remember, 3 forms of inefficiency, but otherwise it's a cool chapter. You can do very fast and finish it, right? So that's it from my side, guys. I'll see you in the next lecture, okay?